Consumer prices in the U.S. increased at an annual rate of 2.7% last month. The report was delayed by the U.S. government shutdown. But let's start there with Gennadiy Goldberg, head of U.S. rate strategy, TD Securities. Thanks for joining us today.
Thanks for having me.
How would you read the market take on the CPI data?
I would say highly confused. To be quite honest with you, there was a lot of quirks in the data. We didn't actually have October collections, so there was a lot of interpolation and extrapolation and kind of assumptions that were in the numbers that created a lot of knock-on effects for November. We're still really getting our heads around what that means. It is a better number. I mean, at the face value of it, inflation really decelerated during the month of November. We're going to give it a couple more months, at least one, possibly even two, for the data to really work off some of those significant disruptions. I don't think there's much to hang your hat on here, to be quite honest with you.
All right. Is that why you call it suspect? Because we don't have the numbers for October? Of course, they were canceled, the release canceled by the shutdown of Washington.
Yeah, it's hard to make too much hay out of this one particular number. It was wildly different from expectations. I mean, we're talking, half a percentage point basically off consensus market expectations. That's really difficult for markets to get their heads around. It's not because we're not thrilled that inflation could be coming down, but because some of the component by component changes don't seem to line up with what we've seen before. Rent inflation, for example, was a lot slower than anyone expected. A lot of that has to do with the way the BLS calculates these things. And when you don't have a month of collections, when the data suddenly disappears, there's a lot of assumptions that are being made. So we are going to wait a little bit until the data is cleaner. Thankfully, we'll get one more reading of CPI, one more reading of payrolls, actually, ahead of the January FOMC report, FOMC meeting, and that's going to be quite helpful for markets.
Okay, on a wider lens, economists had predicted that the tariffs would increase inflation this point of the year, but really that hasn't occurred. If you believe the numbers, the opposite has occurred. So how do you square that?
Well, heading into the shutdown, that is what was happening. We still expect tariffs to push inflation higher. You really have to think about it in three main components. Core goods, so that is the stuff that really is tariff impacted. Core services, excluding shelter, so that's really, kind of the cost of haircuts and things like that. And then housing. Now, housing's been a pretty positive story. It has been weighing on inflation overall. Core services hasn't seen that pass through from goods. The price of haircuts hasn't gone up because your barber's razors have become more expensive. That's the big worry for the Fed. You have been seeing it certainly in the core goods component. You've been seeing those tariff rates actually pushing inflation higher. Now, it really depends on how much more there is. Is this a delay, or is this, really tariffs not pushing those prices higher? We think there is a bit of a delay. We do expect inflation to peak higher than it is right now, early next year, probably at around 3.3% or so, give or take, and then actually come down by the end of next year to about 2.5%. We're obviously taking a close look at those numbers now that inflation's come out well below expectations. But I do think the next couple of months are going to reveal what the trends are looking like on the tariff pass-through.
Okay, let's talk about the 10-year yield at about 4%, even as the Federal Reserve cut the rate. What does that tell you about investor concern?
I think investors are kind of stuck between a rock and a hard place. They are seeing the labor market gradually cool, but not cool sufficiently to actually create panic, which is great. But we're also not seeing inflation accelerate materially. We're not seeing it decelerate materially, except for obviously this 1 month. I think investors are still waiting for clarity. What this means is the Fed may not have sufficient clarity to cut rates at the January meeting. Not a lot of that is priced. There's only about 5 or 6 basis points penciled in by markets of a 25 basis point rate cut. There's substantially more penciled in for March. And I do still think that there is potential for the Fed to continue to cut interest rates. But, our view is 3 more rate cuts in 2026. We're expecting March, June, and September. And really, as those come in, the Fed will be kind of feeling their way around whether they need to cut rates further or they don't. And I think for investors, as long as there's a prospect of rate cuts on the horizon, rates can be relatively contained and can continue to drift lower.
Okay, so why do most think that there will not be a rate cut in January? And do you expect the December inflation information, if it continues that trend that seems to have started last month to carry on, do you think that'll be the clarification they need?
I think the inflation data is going to be just one part of it. I think the labor market is going to be a huge chunk of what they actually really need to see. If we continue to see the labor market deteriorate, so let's say we get a significantly negative number, let's say the unemployment rate rises actually more than expected, maybe we go up to 4.7 or even 4.8, that could certainly open the door for a cut relatively soon. What the Fed did in their last statement was actually insert some language, basically making it unlikely that they continue to cut at every meeting. So it does seem like there is debate within the FOMC, pretty hefty debate about whether they should continue to cut rates at consecutive meetings, whether they should take pauses. The issue is we're getting into some FOMC members' expectations for where the neutral rate is. Remember, those run the full gamut from 2.5 all the way up to almost 4%. The deeper we cut rates here, the better, the more significant the fights get. Most of the committee, so around 70% of the FOMC, thinks the neutral rate is somewhere between 2.75 and 3.5. The closer we go to that, the more the fights are going to break out. So in our minds, they're just going to have to go a little bit slower to make sure that everyone's comfortable cutting rates to where they think they need to cut them.
Got it. All right, Gennadiy, got to leave it there. Thanks for joining us today.